Okay, we begin chapter 7, part 6, accounting rate of return or ARR. Accounting rate of return compares average accounting profit with the average investment cost of the project. The accounting profit can be expressed either before tax or after tax. Okay, dia punya equation dia, ARR ialah average net profit per year over the life of project divided by average investment cost. Okay, how to get average profit, net profit per year is total profit bahagi dengan number of life of the project, number of year, and then average investment cost ialah initial investment bagi dengan 2. And in evaluating the investment project, the ARR of the project is compared with the predetermined minimum acceptable accounting rate of return. Kalau ARR the below the minimum acceptable rate, so we have to reject lah. If the ARR is equals to minimum acceptable rate, we can accept. Or if more than minimum acceptable rate, so should be accept lah. And the highest, yang terbaik, we choose the highest ARR. Okay, we give example. A company considering whether to buy a special machine for production line. Purchase price of 400,000 RM. Estimate useful 4 years. And there's no scrap value after 4 years. So after 4 years it becomes 0. Okay. So kita tengok year 1. Dia ada revenue 310,000, 10,000, and other expenses 150,000. And then this one, dia punya tax, after tax lah. Ni before tax, after tax dia beri. After tax, because dia ada 15%. So, tolak lah. So, should the company buy the new machinery if minimum acceptable rate of return is 20%? Soalan dia. So, kita tengok macam mana menjawab ni. First of all, you have kira average net income. Kita campurkan 51,000 campur bagi dengan 4. You akan dapat average net income ialah 63,750. Then the investment, average investment ialah tadi 400,000. After 4 years it becomes 0. Then bagi dengan 2 dapat 200,000. So the cost of machinery is 400,000 at the beginning. The machinery is 0 at the end of depreciation of after 4 years. After 4 years. On straight line method, and there's no scrap value. So the ARR ialah average net income bagi dengan average investment. You get this one. So the ARR will be 31.87%. Since the ARR is 31.87%, which is higher than the minimum acceptable rate yang kita beri 20%, so the company should invest this new machinery. Okay, another example. Owner of Fresh Farm Foods are planning to open either farm shop or cafe. So they estimate 2 projects. Farm shop dengan cafe. Average sales 62,000, yang ni 109,000. Average cost expense, this one is 43, this one is 82,000. And average employed, capital employed, this one is 100,000 ringgit. Yang cafe is 180,000. So required a pro forma or calculate average profit to each, and the AR using the following formula. Decided which is better of the 2 investment. Okay, kita gunakan average profit bagi dengan average capital employed. And then we have to see the outcome lah, berapa ni. Kita akan tengok berapa AR for farm shop and cafe. Okay, so include the data. 62 of the sale, cost and expenses, 43, and then kita akan jumpa therefore average profit. This one is 18,600 and this one is 27,000. And kalau kita masuk average, bagi dengan average cost and expenses, you get this farm shop is 18.6% and cafe is 15%. So the farm shop give the highest AR than the cafe, but should the owner base their decision purely on this? If we had more information, we could calculate the payback period as well. So company purchase non-current asset, useful economy life of 10 years for, ni satu lagi contoh 10 years dia bayar 1.25 million ringgit. It is expected to generate cash flow over 10 years of 250,000 per annum. Tiap-tiap tahun dapat 250,000 before depreciation. Biar power dia habis lah. So the company charges depreciation over the life of asset on a straight line basis. At the end of the period, it will be sold for 250,000. So what is the accounting rate of return for the investment based on average profit and average investment? Kita kira ARR sama dengan annual profit divided by average investment, and then annual depreciation is minus cost minus residual value per tag, bagi dengan 10 lah, selesai 10 tahun. So it's 100,000 per annum. And then profit after depreciation 250,000 minus dengan 100,000, so dapat the profit will be 150,000 per annum. So average investment ialah harga permulaan campur dengan harga selepas 10 tahun bagi dengan 2, you get this 750,000 ringgit. Therefore ARR ialah 150,000 per annum tadi bagi dengan 750,000 ringgit, you get 20%. Sorry. So this is the advantage of ARR. Easy to understand and compute. It avoids using gross figures. Therefore, it enables comparison to be made between project with different useful life. Jadi kita dapat bezakan dengan baik. But the disadvantage lah, it ignores the time value of money. Macam kita buat net present value tadi lain . So ARR method seem to be less reliable than net present value method. It adopts the accounting profit instead of cash flow calculation. Macam kita cakap cash flow tu penting ikut year sebab tak sama nilai tiap-tiap tahun. So the change of depreciation method may also alter the accounting profit.